If you only look at the macroeconomic data right now, 2026 looks like a massive success story. Gross domestic product is expanding, the labor market is broadly stable, and corporate profits are hitting record highs. On paper, the U.S. economy is booming. But ask the average family how they're doing, and you get a completely different answer. Millions of everyday Americans are experiencing a level of financial stress that completely contradicts those national headlines. It leaves us with a glaring contradiction. If companies are making money and unemployment remains relatively low, why does it feel like household bank accounts are completely detached from the national growth charts? The traditional link between a rising GDP and a rising bank account appears to be severed. Waiting for these broad national trends to reach your personal budget often means watching your savings slowly erode while the headlines celebrate. To find security in this environment, you have to look past the top-level data. You need to understand the specific, mechanical forces that are driving a wedge between the national economy and your wallet. To see the first major force crushing budgets, look at this line graph tracking everyday costs. When you hear that inflation is cooling, it doesn't mean prices are actually dropping. It just means they are rising more slowly. The spike we saw in prices has leveled off, but it has created a rigid new price floor. This means the cost of simply existing is locked in at a much higher tier. Bills for groceries, utilities, and insurance haven't retreated to their old baselines. They are stacked high, squeezing against household incomes that haven't kept pace. Even for workers receiving raises this year, the math is difficult. The stretching power of a paycheck is lower than it was a few years ago because it has to cover this newly elevated baseline for basic survival. People are feeling this rigid new baseline every time they swipe their cards. Recent surveys show that households expect inflation to remain above the Federal Reserve's 2% target for the foreseeable future. A cooling inflation rate simply means everyday costs are rising at a slower pace, but they are still compounding on top of record highs, permanently raising the cost of basic needs. This brings us to the Federal Reserve and the tightrope they have to walk. They must attempt to suppress this lingering inflation while simultaneously trying to keep the broader macroeconomy expanding. We can visualize the Federal Reserve's mandate as a massive balancing scale. To offset the heavy weight of lingering inflation, they use interest rates. Rates have stayed relatively high compared to the ultra-low borrowing costs Americans enjoyed for years, pushing down forcefully on consumer borrowing power. But that top-down policy makes borrowing money more expensive for the average person. Credit card APRs, auto loans, and mortgages now require a much larger portion of a household's monthly income than they did in the past. The American consumer is caught in an economic vice. You are being pushed up from the bottom by the high price floor of everyday essentials and crushed from the top by expensive debt. The very medicine the Federal Reserve uses to stabilize the national economy is the same force making it harder for the average family to finance their daily lives. Despite this squeeze, many households are finding a way through. They are choosing proactive adaptation over waiting for the headlines to improve. Their immediate defensive strategy focuses on escaping that vice grip. This involves aggressively paying down high-interest debt to relieve the top-down pressure and ruthlessly eliminating unnecessary monthly subscriptions to create breathing room at the bottom. Once the defense is set, they move to offense. They build robust emergency savings to insulate themselves from future shocks and consistently increase their retirement contributions, regardless of the daily market news. Financial success in this environment doesn't require predicting the Federal Reserve's next move or reacting to corporate earnings reports. A growing national economy provides no guarantee of personal financial security. That stability is instead built through the consistent, small, and informed decisions that create a resilient personal economy.